What if I told you that the banks and Wall Street insiders are playing a game with your money, and most traders have no idea how to win? Rabbi David reveals the secrets of smart money trading that the financial elite don't want you to know. Watch closely, because these insights could change the way you trade forever. To trade like the elite, you first need to understand what smart money really is. Contrary to what many think, smart money isn't about having more luck, more information, or better intuition. It's about power, strategy, and precision. Smart money represents the large financial institutions, hedge funds, banks, and professional traders who control massive volumes of capital. Because of the sheer size of their positions, these players move markets, create trends, and set up retail traders to react. Think about it. When a small retail trader buys or sells a few hundred shares, the impact on the market is negligible. But when a bank or hedge fund moves billions, the market shifts in response. That's why it's critical to study the behavior of these institutions, not just the price charts. One of the first signs of smart money activity is price stability before volatility. These institutions don't randomly throw their money into the market. They build positions quietly. They accumulate large amounts of shares without causing the price to spike, often in low-volume periods when retail traders aren't paying attention. By the time most people notice, the trend is already set. Another key aspect is understanding liquidity zones. Smart money requires liquidity to enter or exit trades without disturbing the market. They target areas where stop losses cluster, often just beyond obvious support and resistance levels. Recognizing these zones can give you insight into where major players are likely to act next. Volume analysis is another critical tool. While many traders focus purely on price, smart money is more concerned with volume and how it interacts with price. Unusual spikes in volume, especially near key levels, often indicate that institutions are entering or exiting positions. Learning to interpret these volume shifts allows you to anticipate moves rather than react to them. It's also essential to understand that smart money is patient. These institutions aren't looking for small, quick wins. They often hold positions for weeks or months, guiding the market in their favor. For a retail trader, this means that the strategy is not about chasing every trade or trying to catch every spike. It's about aligning yourself with the direction that the smart money is pushing the market, even if it requires patience and discipline. Finally, smart money trading is psychological warfare. The market is a battlefield of perception. Retail traders often act on fear, greed, and emotion, which is exactly what institutions exploit, by observing patterns of panic selling or euphoric buying. Smart money can create opportunities for themselves. Understanding this psychology is just as important as reading the charts, because it allows you to anticipate retail reactions and position yourself ahead of the crowd. In short, understanding smart money is about recognizing that the market is not a free playground. It's a structured environment where capital, strategy, and patience determine winners. Retail traders who study this can transform from reactive participants into strategic players who see the moves before they happen. Market manipulation is one of the most misunderstood concepts among retail traders. Many assume that it's illegal or only happens occasionally, but in reality, manipulation is baked into the structure of modern markets. It's how institutions exploit retail behavior to accumulate profits, while the average trader reacts blindly. The first step in understanding market manipulation is recognizing the difference between real moves and fake moves. Price charts don't tell the full story. They only show the outcome of thousands, sometimes millions, of trades executed with intent. Manipulation often involves creating false signals, luring retail traders into positions that benefit institutional players. One common tactic is pump and dump scenarios in volatile markets. While retail traders see a rapid spike in price and rush to buy, large institutions are quietly selling into that enthusiasm. The result: the retail crowd suffers losses while the smart money profits. Recognizing these patterns requires analyzing volume, timing, and historical price behavior rather than relying solely on headlines. Another major technique is stop-loss hunting. Institutions know that retail traders often place their stop-losses just beyond obvious support or resistance levels. By pushing the price to trigger these stops, they create liquidity for themselves. For example, a sudden drop that triggers dozens of retail sell orders isn't random. It's an opportunity for larger players to buy at a discount, setting up for a significant upward move. Understanding these manipulations allows traders to avoid common traps and even position themselves to benefit from them. Market manipulation also occurs through false breakouts and fake reversals. A breakout may look like a strong upward move, but if volume is weak or certain price levels act as invisible resistance, the breakout could be engineered to lure traders into buying before the market reverses. Similarly, fake reversals are designed to shake out weak hands before the true trend continues. By observing price action, volume, and order flow, traders can distinguish genuine trends from deceptive setups. One of the most critical points is that manipulation is psychological. Institutions understand human behavior. They exploit fear, greed, and herd mentality. Retail traders often panic sell during minor dips or chase gains during minor rallies. Institutions anticipate these reactions and use them to create favorable conditions for themselves. Recognizing the psychological aspect of market manipulation is as important as reading charts or analyzing data. In essence, market manipulation isn't about randomness or luck. It's about control, strategy, and patience. Once traders learn to spot these engineered moves, they stop being victims of the market and start using the same insights to make calculated, informed decisions. Understanding market manipulation naturally leads to the next step: decoding institutional trading strategies. These strategies are not just a set of rules, they are carefully engineered systems that exploit market structure, psychology, and liquidity. While retail traders focus on short-term profits, institutions think in terms of capital efficiency, risk distribution, and long-term positioning. One of the primary strategies involves accumulation and distribution. Institutions rarely enter the market all at once. They accumulate positions gradually over time to avoid pushing the price against themselves. During this accumulation phase, retail traders may notice slow movements or low volatility, unaware that a massive position is building. The distribution phase works similarly but in reverse, allowing institutions to sell into retail buying pressure without causing a sharp market crash. Recognizing these phases is key to aligning with the real market movers. Another widely used tactic is liquidity targeting. Institutions need liquidity to enter and exit trades effectively. They often push prices toward areas where retail traders cluster their orders. This is why support and resistance levels are so commonly tested. By observing where large clusters of stops or limit orders exist, traders can anticipate potential points of market absorption or breakout. Trend creation and management is another cornerstone of institutional strategy. While retail traders often follow trends, institutions frequently engineer them. They create a clear directional movement over days or weeks to encourage retail participation. During these engineered trends, retail traders often enter late and at unfavorable prices, while institutions profit from both sides, selling at peaks and buying at dips. Learning to identify trends that are institutionally driven rather than purely market-driven gives retail traders a predictive edge. One advanced concept is order splitting. Large institutions never execute their trades in a single transaction. Doing so would move the market against them. Instead, they split orders into smaller chunks, executing over hours or even days. Observing unusual repeated patterns in order flow, especially around key price levels, can reveal institutional intent. Over time, understanding these patterns allows traders to anticipate bigger moves before they are visible on standard charts. Risk management is integral to these strategies. Unlike retail traders, institutions rarely risk more than a small percentage of their capital on a single trade. They use hedging, diversification, and position sizing to protect themselves while maintaining influence over the market. This disciplined approach is why institutions survive and thrive even during extreme volatility. Retail traders can adopt similar principles to protect themselves while trading alongside larger players. Another key element is market timing. Institutions are acutely aware of economic events, news releases, and market sentiment. They use these triggers to execute trades at optimal moments, taking advantage of volatility spikes. This doesn't mean retail traders need inside information. It means learning to anticipate likely points of institutional activity and aligning trades with those periods of increased liquidity and movement. Finally, institutional strategies emphasize data-driven decision-making. Every trade order and market action is analyzed for maximum efficiency. Retail traders can mirror this approach by tracking volume, order flow, support and resistance zones, and historical price reactions. The goal isn't to mimic institutions exactly, but to understand their logic and positioning so that retail trades are executed in alignment with the dominant market forces. By combining knowledge of market manipulation with institutional strategies, traders gain a complete perspective on market behavior. Instead of reacting to price changes blindly, they learn to anticipate moves, avoid traps, and position themselves strategically. This approach transforms trading from a gamble into a calculated pursuit of opportunity. Risk management is not a supplementary part of trading. It is the foundation. Without it, even the most insightful market predictions can lead to catastrophic losses. The first step in professional risk management is position sizing. The amount of capital allocated to a trade should reflect both the trader's risk tolerance and the potential volatility of the asset. Institutions rarely risk more than a small percentage of their capital on a single trade, and retail traders should adopt a similar mindset. One of the most important concepts is risk-to-reward ratio. Every trade should be evaluated based on the potential profit versus the potential loss. A common guideline is aiming for at least a 1:2 ratio, meaning the potential reward is twice the potential risk. This ensures that even if a trader loses more trades than they win, profitable trades can still outweigh losses. Another critical aspect is stop-loss placement. A stop-loss is not arbitrary. It should be strategically positioned at levels where the trade thesis is invalidated. Placing a stop too close may result in being stopped out by normal market fluctuations, while placing it too far increases potential losses. Professionals often use technical analysis, support and resistance levels, and volatility measures to determine the optimal stop placement. Diversification is another key principle of risk management. Even the most confident trader never puts all capital into a single trade, asset, or market. Spreading exposure across multiple trades or instruments reduces the impact of a single adverse move and stabilizes performance over time. Risk management also requires an understanding of psychology and discipline. Traders must accept that losses are inevitable and that no strategy wins 100% of the time. The goal is not to avoid losses entirely, but to control them, ensuring that one bad trade does not derail long-term success. Emotional reactions, such as revenge trading after a loss, are a primary reason many retail traders fail. A disciplined risk management plan prevents emotions from dictating decisions. Advanced risk management includes hedging. Hedging involves taking positions that offset potential losses in primary trades. For example, a trader may hold a long position on a currency pair while simultaneously taking a smaller short position in a correlated asset to reduce overall exposure. Institutions use complex hedging strategies, but the principle can be applied by retail traders to manage risk effectively. Monitoring market volatility is also crucial. Volatile markets require adjusting trade size and stop placement to account for rapid price swings. By understanding volatility patterns, traders can protect themselves from unexpected spikes and dips while positioning for potential gains. Finally, a professional approach to risk management includes tracking and analyzing performance. Every trade should be reviewed to determine what went right, what went wrong, and how future trades can be improved. This continuous learning cycle transforms risk management from a defensive strategy into a competitive advantage, helping traders survive and thrive over the long term. When risk is managed effectively, trading shifts from a game of chance to a calculated pursuit of opportunity. It becomes less about predicting every move and more about positioning oneself to survive losses and capitalize on favorable conditions. Knowing when to enter and exit a trade is as important as knowing which trades to take. Many traders make the mistake of chasing price movements or entering trades too early without confirmation. Professional traders focus on precision timing, using data, market behavior, and pattern recognition to identify optimal entry and exit points. The first principle is aligning entries with market structure. Retail traders often enter based on emotion or news, while professionals wait for confirmations from support, resistance, and liquidity zones. Entering a trade at the wrong time, even if the trend is strong, can lead to losses or poor risk. In modern trading. Raw observation alone is not enough. The markets move quickly, and missing a single signal can mean lost opportunities or unnecessary losses. Smart traders rely on precision tools and indicators that reveal patterns invisible to the naked eye, allowing them to trade like institutions without the need for insider access. The first category of tools is volume-based indicators. While price charts show what has happened, volume reveals how strong the moves are. For example, a breakout accompanied by high volume suggests institutional support, while a breakout on low volume may be a trap designed to lure retail traders. Tools like Volume Profile and VWP allow traders to see where most trading activity occurs and identify potential accumulation or distribution zones. Another key tool is the order book or depth of market. This shows real-time buy and sell orders at different price levels. By analyzing the DOM, traders can detect liquidity clusters, hidden orders, and potential stop-loss hunts. Institutions use this information to gauge market sentiment and influence price, but retail traders who study these patterns can anticipate moves instead of reacting blindly. Price action indicators are also essential. Smart traders watch for patterns such as pin bars, engulfing candles, and key support-resistance interactions. These patterns often indicate potential reversals, trend continuations, or fakeouts. When combined with volume and order flow analysis, price action becomes a powerful confirmation tool. Momentum indicators like RSI and MACD are used not just to spot overbought or oversold conditions, but to gauge the strength of a trend. Smart traders rarely enter trades against strong momentum. Instead, they wait for pullbacks or retracements that align with institutional positioning. Another critical tool is charting and multi-timeframe analysis. Institutions rarely make decisions based on a single timeframe. They observe trends across daily, hourly, and even minute charts to determine the broader market context. Retail traders can mimic this approach by analyzing multiple timeframes before entering a trade, ensuring alignment with larger trends while avoiding short-term noise. Alerts and automated scanning tools are also part of a professional's toolkit. Modern trading platforms allow traders to set alerts for price levels, volume spikes, or order flow anomalies. These tools ensure that traders never miss critical signals and can act decisively when conditions align. Finally, professional traders use journals and analytics software to track every trade, recording entries, exits, volumes, and the rationale behind each decision allows traders to analyze performance, identify weaknesses, and continuously improve. This disciplined approach transforms tools from simple aids into decision-making systems that amplify effectiveness. The takeaway is clear. Tools and indicators are not just gadgets, they are the eyes and ears of the market. Used correctly, they allow traders to detect the subtle footprints of smart money, anticipate moves, and make confident, informed decisions. Even with knowledge and tools, the difference between theory and success comes down to actionable steps. Smart money trading is not about guessing. It's about structured, disciplined execution. Every step taken should be deliberate, strategic, and aligned with the insights we've discussed. The first actionable step is market observation. Start by tracking the assets you want to trade, focusing on volume patterns, price action, and liquidity zones. Identify how price reacts to major support and resistance levels and notice where stop-loss clusters might exist. Observation is the foundation. Before placing a single trade, you must understand the underlying rhythm of the market. Next is alignment with institutional activity. Use tools like order flow analysis, volume profiles, and DOM to see where smart money is accumulating or distributing positions. Your goal is not to fight against the market, but to position yourself where the larger players already are. Even a small trade in the same direction as institutions can be more profitable than chasing after volatile swings. Risk planning is step 3. Before entering a trade, define your stop, loss, and take profit levels. Calculate position size based on your risk tolerance and market volatility. Never enter a trade without knowing your maximum potential loss, because controlling losses is what keeps you in the game long enough to profit consistently. The fourth step is precise timing and confirmation. Instead of reacting to price spikes or news, wait for confluences of indicators, for example, a support level aligning with a volume spike and favorable momentum. These confirmations reduce false signals and increase the probability of success. Remember, entering too early or too late can turn a promising setup into a losing trade. Step 5 is disciplined execution. Follow your plan exactly. Avoid emotional reactions. Resist the urge to add to losing positions or deviate from predefined stops. This discipline separates successful traders from those who fail despite having excellent knowledge. Every trade should be executed with logic, not emotion. The sixth step is continuous learning and adaptation. Markets evolve and strategies must evolve too. Keep a detailed trade journal to record what worked, what failed, and why. Over time, patterns will emerge, helping you refine entry points, stop placement, and trade management strategies. This iterative learning process builds both skill and confidence. Step 7 is scaling with confidence. Once a trader consistently identifies profitable setups and manages risk effectively, Gradually increasing position size or exposure becomes possible. But scaling should always respect risk parameters. Even small increases in capital allocation can dramatically amplify results if done strategically. Finally, step 8 is long-term perspective. Smart money trading is not about chasing every trend or making quick profits. It's about playing the long game, aligning with market forces, and leveraging knowledge, tools, and strategy for consistent performance. Patience is key. Surviving losses, avoiding traps, and waiting for high-probability setups ultimately separates professional traders from the majority. In practice, a retail trader following these steps would observe the market daily to identify patterns, analyze volume, price action, and order flow to detect institutional activity, calculate risk and position size before placing trades, enter trades only when multiple indicators confirm a setup, stick to stops and predefined exit points, review every trade to refine strategies continuously, gradually scale positions while keeping risk controlled, maintain a patient, disciplined approach focused on long-term profitability. When combined, these steps create a repeatable, high-probability trading system. Rather than relying on luck or emotion, a trader now operates with a strategic framework informed by the same principles that guide institutional play.